Welcome to the Jay Martin Show. My name is Jay Martin. If you are new to the channel, I am an investor looking for the best home for my cash. I have conversations on this channel that get me closer to the right answers to that question. So if you're an investor just like I am, then hit subscribe to this channel, wherever that button is, and you'll never miss an update. Now, my guest today is Dr. Mustafa Chowdhury. He is the Chief Rates Strategist at Macro Hive. He's also known as the godfather of rate hedging. So no surprise, what we talk about today is his prediction for rates and how to adjust your portfolio accordingly. As always, right beneath this piece of content is a link where you can subscribe to my weekly newsletter. I write an essay every single Sunday and I send it out for free. It's my key lessons and takeaways from conversations just like this and plenty others. And although I'm an investor and I manage a portfolio of early stage companies, I write more frequently about managing my mind while managing money, not necessarily managing money, because this is the most important tool in the investor's toolkit and the one that will steer you in the right or wrong direction. So every Sunday, I fire out an essay. It's free. Join 40,000 other investors and get that from me every Sunday morning. Here is Dr. Mustafa Chowdhury. Enjoy.
This is Jay Martin.
All right, here I am joined by Dr. Mustafa Chowdhury, the godfather of rates hedging. It's a pleasure to have you on the show. Thanks so much for making the time to chat with me today.
Thanks for having me, Jay.
So here's where I thought we should start. A lot of my guests recently have been looking at the inverted yield curve and making the assumption that based off of what they're seeing, there's a trend of money flowing towards long-term safety and liquidity, and that we haven't even begun to see the worst of the recession, specifically in the United States, but generally speaking, globally. Would you agree with that analysis? And if so, elaborate on it. And if not, how do you see things differently?
It's a great question to start with. I must say that the shape of the yield curve is very unusual, in my opinion. It's common to think that the very inverted yield curve basically projects or predicts a recession ahead of us. But we keep saying this for last 1 year. The yield curve has inverted. This is like 1 year anniversary of the inversion of the yield curve, and no recession yet, no sign of recession. Economy, the data is very strong actually recently. In jobs, in housing, everywhere. So the inverted yield curve, firstly, the shape within the inversion, it is a little bit unusual. I would call it a hockey stick shaped yield curve, straight down, very fast for the next 2 years, and kind of flat after that. It's as if nothing happens for 2025 to forever. So I think what's happening is that the market, there is a lot of technical flows. So evidence number one, as I mentioned, and the other one is that when the banking crisis started, or the four banks got into trouble in early March, we had overnight more than 200 basis point move in close to 150-ish basis point move in the 2-year rate. So when market rallies, it really rallies a lot. When it sells off, it seems to sell off very slowly. It tells me that a lot of people has put on this carry trade almost like free money, because the yield curve is saying that there will be imminent recession, nothing happens, and if you hang on to that trade, then you make actually a lot of money from the positive carry from shorting a interest rates in the near term. So because there is this very large amount of positions in there, the market seems to keep mispredicting the Fed. So Fed hikes 25 basis point at a clip right now at this point, and the market then prices another 25 basis point in the yield curve. and then unwinds that a year later. So basically, inverts the curve. Every time Fed hikes, there is a corresponding ease priced in 2024 or 2025. So the net from 2020 after 2025, seems to be no change. So I don't think it predicts, maybe it predicts somewhat of a recession, but it's not all about recession. It's about how the market is betting this curve at this point. But eventually a recession will happen. We will have to wait longer than most analysts or economists have predicted, and maybe a long time, because there is absolutely no sign, except for one place. I'll get to that later. There's not much sign of a recession.
Oh, I'm so curious about the one place.
This one place is small banks.
Yeah. Okay.
So what's going on is that we saw that when we start to look at the banking system after the Silicon Valley Bank collapse, that there is a big distinction between small banks and large banks in the US. So let me first say why I am not so negative about the economy yet.
Sure.
It's just a timing question. Like, it's not going to happen anytime soon, but there is a slow process grinding that will eventually get us to a recession. Usually what happens is that by this time, with this monumental amount of rate hike that has already happened, consumers should have weakened. And the demand should decline, and the lower demand would then eventually lead to less production and less hiring, and we would get a recession through the consumers, because American economy, 75% is about consumption, about households, and that channel from Fed hike to recession is not happening because consumers are unusually strong after a 525 basis point of Fed hike. And I will talk a little bit about why consumers are strong. Then I'll tell you why this other place, which is the small banks and their customers, which are small businesses, are the weak links in the whole system right now. Historically, not as much, but this time, it is. Consumers are strong because they are locked into mortgages. The households that have homes are locked into mortgages at an amazingly low rate in a high rate environment. So if you're at home and you're locked into a 2.5 mortgage, and now mortgages are 6.5, you are 4% in the money. And if the average homes in the US, like 400 plus, on your balance, you have a huge gain in your value, in your household asset value, just from the mortgage gain. And then not only the gain from the mortgage, there is other things that consumers have gotten that leaves them at a really good position. So we don't see we see retail. If you look at the retail demand, retail sales still solid. We see housing still on not, if not on fire, very strong. In the last, especially this May data in US housing, everything seems to have turned around. And whether existing home sales, the new home sales, home sale prices, every piece of the data pointing to housing seems like it has turned around. You get apartment rents coming back up. It was going down and then coming back up. So that channel is not happening this time. It's a huge surprise for Fed, because Fed probably was hoping this was going to happen a long time ago, and we will start to see inflation start to go lower. Where there is weakness is in the small banks. Because small banks did a big mistake, which is when the Fed was running a zero interest rate scenario and pumping massive amount of QE into the system, they did one thing that if you look at the history of small banks, small local banks in the US, they never did this. Usually what small banks do, their clients are local and local businesses. And so they get their deposits from locals, and then they lend to local businesses, mostly for commercial properties, shops, things like that. And usually they don't get into real estate, especially home mortgage business. This time was unusual. Since the Fed pumped this huge amount of reserves in the system, small banks were flooded with reserves, and they didn't know what to do. So they bought a lot of MBS, which usually a forte for the large banks and not for small banks. And they also bought US Treasuries, which, if you look at the history of banking in the US, you'll never find a time when, maybe in the 70s or early 80s, that banks would buy 2-year Treasuries. But those days were gone a long time ago. And now, if $1 trillion American small banks sitting on more than $1 trillion of MBS and treasuries with duration in them. So deposits are starting to move. I just checked the financial statements of about 145 small banks from the first quarter financials, and the non-interest deposits have declined. The median is about 10%. There are a lot of banks with 20% decline in non-interest deposits, and significant compression of net interest margin for the small banks, because they're sort of stuck with long duration assets, and their deposit assumptions about how long the deposits are going to be in the book are starting to turn out to be incorrect. So average bank assumes that about the deposits have a 5-year duration, which means sort of on average, it will be the sensitivity of their deposit book is going to be about every 100 basis point change in interest rates will be the deposits will there will be basically means there will be very little deposit movement, and that assumption is turning out to be wrong. We will see in the macro data a little better, but I'm actually looking at some of the individual banks' financial statements, and it's starting to move. Not to the point that it's a crisis, but it'll boggle my mind if they lend anything and to anybody at this point, being stuck with this mortgages and treasuries. So, and their borrowers are usually small town businesses with 4 or 5 employees, shops, restaurants. So I think that's where we will see the effect of Fed hike, but that's really a slow process, because it's going to go through, and we won't see that, I think, yet in the lending survey, Fed survey, etc. That will take some time, but I think we will start to see small banks pretty much shut down lending to small companies, and that's where job losses will start to happen.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. Okay. Let me pull in a couple threads there. So one thing you shared was that, consumption has been unusually strong. And one of the reasons that's been the case is just because if your house is financed at 2% and rates are now 6%, you feel in the money, you feel a bit wealthier. And that's going to encourage consumption versus austerity, right? If the value of your home depreciates, for example, it may not be an asset you intended to sell, but just because the value went down, you start practicing more austerity because you feel poorer than you did 6 months earlier. So, questions around that is like, what's going to curtail that unusually strong consumption? From there, you went into the small banks. There's a handful of things occurring here, some consolidation. You touched on the average duration of a deposit being 5 years, and that's no longer proving the case, especially for these small banks. That's really interesting. And obviously, we've seen that in spades. And that in combination with the rates is going to lead to decreased lending. The small banks typically service small business. So if small businesses don't have access to capital, they're going to have to cut back on growth plans, maybe operational costs, maybe that leads to job losses. And that is one of the catalysts that will eventually start to pull consumption down as well. How'd I do there in terms of?
Yes, that's a flow versus stock concepts. Homeowners are not only feeling richer, they're also feeling less risky. Because remember, their life is less sensitive to interest rates than it was in the past, because most of the interest rate risk that homeowners should have is actually held by either Fed or the banking system because of their gigantic portfolios. And so they're wealthier and they're less risky than usual for homeowners. And it's very unusual in a Fed hiking scenario. It's not just unusual at a normal time, but more unusual in a Fed hiking scenario. So, but that's the stock concept. And the flow concept is when you lose your job, even if you have a great mortgage, you still lost your job. So that's going to come through the small business channel. But the thing is that because it's coming through the flow rather than flow and the stock together, I don't know whether I articulated it right, it's going to be a little slower. The recession is going to be slower to come.
Okay, I'm with you. And, actually to back up to where we started this conversation, you're like, the recession is coming, just not as quickly or as immediate as most economists are predicting. There's kind of two things going on there. I believe number one is that economists love to predict recessions. It's a great business to be predicting a crash. People bite on the headline every single time. It's exciting. It's seductive. The sky's about to fall. And they don't have to be right. See, when you predict a crash and you're wrong, everybody forgets the next day. When you predict a crash and you're right, they make a movie about you, right? It's called The Big Short. Right?
Exactly.
And so it's a good business to be in because there's this insane forgiveness for when you're wrong, but when you're correct, you're heralded as a guru, very inappropriately, in my opinion. The problem with predictions, even bigger than that, is that consumers believe them, right? And then if I am told by this economist that I trust that there will be a crash in June, and it drives me crazy when economists and analysts make predictions and tie them to specific dates, because then retail investors listen to those predictions, and if that event doesn't occur on that date, then they just believe it's not going to happen, not that it might happen 6 months later. And so they change their plans and their portfolio accordingly, when in reality, it's like you can spot the big trends, but try to put that on the calendar, that's a whole different game. And I would say an impossible one. But what do you think about that?
I think it's easy to, there are examples that of consumers being very smart. One of them is the Michigan, if you look at the Michigan data that just came out, which shows the consumers' forecast of inflation is 1 year ahead inflation is 4.2%. So the US consumers are predicting deeply ingrained in their heart a very high inflation rate, and they're not they don't believe the Fed will succeed in bringing inflation down to their target, although the chips market is saying somewhere around 2.5%, 2.25%, 2.5% break-even inflation. The consumer is saying 4%. So there's actually a historically large disconnect between the two. And basically consumers are not believing that the Fed's gonna succeed this time. So that's the thing, that it's the inflation is now fairly ingrained in consumers' mind.
It is. Okay. Now, what do you make of where do you land, I suppose, in terms of us experiencing the next 3 to 5 years, an increase in inflation or an increase in deflation? I recently had Jeff Snyder on the podcast a couple days ago, and he outlines a pretty compelling case for why all the inflationists are wrong, why we're going to see a decrease in the velocity of money, leading to or stemming from worse job numbers, leading to decreased GDP. All this. Where do you land on this inflation versus deflation narrative?
Long term is very far, so I will talk about more in the next near term, and then we'll maybe also pontificate a little bit about the long term.
Sure.
Forecasting long term inflation is harder than people think, but I think I don't see.
Hold on, sorry. Did you say long term it will be hotter than people think? Is that what I heard?
It's going to be harder. It's going to be very hard to tell how the long. Because there are a bunch of things going on. Very hard to tell because there are a bunch of long-term trends going on. Big one is the population and the demographics. Deglobalization is a gigantic one in terms of inflation. So and then the economy cyclical stuff. You have the cyclical variations, and then you have this whole massive demographic changes ahead of us. Deglobalization, all of that is going to move inflation in various directions. But near term, in the next year or so, it's really difficult to see significant inflation in my mind. And even if as I mentioned, the weak link, which is the small bank to small firm, keeps sort of going on. And that's mainly because some items of consumptions there is no sign of declining. And that's the biggest one is shelter. There is no sign of any decline. We had some decline in the rental rate, as we saw in the Zillow.com. It's coming back up. Apartment vacancy rate is lowest in 40 years. And if you calculate the buy versus rent calculation, there is no one in their right mind would conclude that they would need to buy a house. So it's everyone's newcomers, new households, whoever needs to have a home, our obvious decision is renting. So the biggest item in American households consumption, there is no sign of any decline. I think it's actually going to come back up. If you look at some of the jobs data, it's strong, and any weaknesses have been reversing as well. So in a cyclical sense, there's odds of the inflation would remain robust. Odds of hitting anywhere close to Fed's target is almost negligible. In the long run, it's going to be between the effect on demographics, immigration, and then, of course, the deglobalization. Deglobalization is huge in terms of inflation, and that's a whole different topic. And what will happen in terms of deglobalization, it's hard to predict for me. But deglobalization could be massively inflationary just because of the labor cost redistribution. that will happen.
And so
But
and so you don't necessarily need to be able to predict how deglobalization will shake out, because that's a really tough game as well. Like the chessboard is being reshuffled. We don't know where the pieces are going to land yet.
exactly.
What we do know is that the predictability of supply chains is completely up in the air, and everything's on the table. And where we will get the stuff we need is a question mark at this point, including labor, as you just mentioned.
The labor is the big one. Like, what's going to be your labor cost 5 years down the line? If you move your production from point A to point B, it's hard to predict right now.
Yes. Okay. Which is, you would make the assumption, an inflationary catalyst for sure. It's
most likely, and more inflationary than disinflationary.
Yeah, more inflationary than disinflationary. Okay. How are you structuring? If you want to talk about your portfolio, by all means, as much as you would like to share, or where are you seeing money go? What I want to get a sense of now is, based off of how you're viewing the economy, where is the smart money going? What's the defensive play? Is there an offensive play? And what might that be?
The offensive play has been, I think, that heavily in the free money that's in betting against the forwards that's going on. That's very risky also, because we saw big losses right after the Silicon Valley related rally. But if you don't have one of those and you can pick up carry for a few months, it's given a reasonable leverage level, it can have significant amount of money to be made, especially if you have option plays around 1 year forward, 1 year rate, for example, buy pair options or short, mostly buy pair options or straddles on 1 year straddles on 1 year rate. Some things like that are offensive plays, but very profitable and consistently been profitable for a while. In defensive play, and I think a smart one is, especially in the context of my view and my colleagues' view at Macro Hive, is that Fed's going to come back. Fed's going to have to hike more and hike a lot more. And so have a significant amount of money market funds, and keeping your dry powder is probably a very good defensive trade. We're not there yet that something is going away from us and we are gonna miss the bus like previously 2000 and early 2019. I think we had when Fed still kind of easy money policy, it's hike a few and then they will stop and the boat's gonna leave, so you have to buy something risky asset. We're not in an environment right now. There is time, but I am heavily into money market funds, and proposing that keep dry powder. There will be great opportunities in the future. I also am suggesting tips to our clients, especially intermediate maturity tips, because I don't think Fed will be able to bring inflation back to 2%. They will have to, even if they will not announce it publicly, formally, but they will they will either not be able to get to 2% or abandon the 2% target. So generally positive on intermediate maturity tips. 1.5% real rate, plus we get 3% inflation. That seems like a very good, decent long-term play. I'm still a little bit positive on the dollar because I don't think Fed's done yet. And bet on the US consumers. US consumers are on much better shape than US firms. So consumer-related assets are good, like MBS. Great yield, government guaranteed, and in general, consumers, anything that's that exposes you to American consumers is probably a good trade. So those are the four things that I'm focused on. There is an aggressive part that I've been telling clients also, this more play a little bit against the yield curve in the front end, but that's for risky players.
Okay. I like the statement. U.S. consumers are in better shape than U.S. firms. I mean, I get it, I guess. Strictly looking at the balance sheets, in general. Look, I want to thank you for coming on the show, Mustafa. It's been great chatting with you. Thanks for making time to get in front of my audience. I appreciate it.
Absolutely. It's my pleasure.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.